And after I made a lot of money in the futures market in the gold side, I wondered why in the heck did silver outperform gold so substantially? And why did Hunt focus on silver and not gold? And so I did kind of a similar study to what Franklin accomplished. And again, I came to a similar conclusion that they're both necessary. You should own both. Gold preserves your wealth. Silver can at times make you wealthy because it can outperform gold substantially. And going back just a moment, so what put me on the silver was like my friend Franklin Sanders that wrote the Silver Bonanza, who was kind of a gold bug until he was commissioned by James Blanchard to write the Silver Bonanza as a co-author. And once you start looking at the silver market, you discover everything that's good about gold is twice as good about silver. Those aren't his exact words. But I went through the same process. I was pretty much a gold bug, self-taught Austrian economics, self-taught monetary history, and looked at gold being the answer during the inflation in the 70s when I was a very young man. When I talked about the metrics of silver, of gold going up 10% CAGR, silver did about 9%. But during the 2008 financial crisis, gold got cut by 30% and double. Silver got cut more than half, but it went up fivefold from that bottom. So if you think we're entering another financial crisis, history doesn't repeat, it rhymes, but I think it's a good time to get in. So that's a long answer, but silver to me has what I call a natural corner. And what does that mean? It means that the trend for industrial usage will take up all the silver at some point. Probably, this is theory, this is projection, this is curve fit by 2030. So we're only 8 years away from the current trend continuing that more and more silver is needed for obviously photovoltaics, electric vehicles, more electronics, more semiconductors, and on the story goes. So I'm still bullish silver long term. The issue, if you want to call it, is that we had all of it that front loaded. In other words, from 2000 to 2011, you couldn't go wrong buying gold. Yeah, it certainly had an up and down move, especially in 2008 during the financial crisis. Gold sold off like everything else, but was the first to recover. It went from about 1,050 down to 700, a little more than 30% loss, but it doubled from there, seeing the financial crisis for what it was. And since then, we've basically been consolidating in what's called a U pattern. So we've been basically frustrated as gold bulls for the last decade. But accounting for the frustration of 10 years and the euphoria of 11 years and putting it all together to where we are now, we still achieve what gold is supposed to achieve. What's that? Preserve your wealth. So if you look at the compounded annual growth, 10%, versus real numbers from John Williams, Shadowstats.com, who utilizes the CPI metrics from 1980, he's averaged about 9% inflation. So gold has done its job. Furthermore, if you look at it from 2000 to present day, it's outperformed the S&P 500 and it's outperformed the bond market. So anyone that says gold isn't doing their job is obviously not aware of these facts. Now, I have to admit, I'm picking the starting line. But, we're supposed to pick the starting line when you're at a bottom. And no one was jumping up and down more than me. Maybe Brian, but just behind me. I was the leader.
I was there.
The time to buy.
Looking at inflation, the analyst noted that the U.S. 5-year break-even inflation rate is highest level in a decade. The precious metal refiner noted that short-term inflation has also surpassed long-term expectations. Last time the 5-year break-even inflation rate was this high was in 2011, and silver was trading around $48 per ounce, almost double the current price, with precious metals seen as an efficient hedge against inflation. Higher inflation expectations should provide upside for silver.
Yeah, it's price inelastic. In fact, most industrial users will pay any price for it because it costs so little in terms of the output. Let me explain. If you've got a $1,000 refrigerator and you're using $5 worth of silver at $20 the ounce, silver goes to $200, it costs you $50, but you're still selling a $1,000 refrigerator. And that's a good analogy for almost all uses in silver, except for silverware, which is a different classification, or silver jewelry, which is a different classification. But your question is, does that tamper the market? Believe it or not, it does somewhat. But again, all markets move at the margin. So it's the last bid that moves the market. So it's that monetary demand or decreasing demand that moves the market. So once the market's been stable, and you'll see this in the charts, it'll go sideways for a very long time, showing some stability for sometimes months on end. Then all of a sudden there's a big short sale by one of the bullion banks, and then the price gets knocked down, over a 3-week period, let's say 30%. And then you'll see the trading funds look at it, and their algorithm kicks in and says it's a time to buy, and they'll start buying and drive the price back up. And that game has been going on for almost forever, pretty much most of my career.